On Bloomberg.
Futures are rallying. We are moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. Take a look at what we see on futures right now. Just about 0.7% of 1%, 0.2% on S&P futures. NASDAQ 100 futures, the Q's up 1% right now, and even the small caps are up about 0.7%. In terms of the bells this morning on the New York Stock Exchange, ADT ringing the opening bell with looks like a tugboat captain there. And then over here on the NASDAQ, we see BYMA, Bolsas y Mercados Argentinos. That's pretty exciting, ringing the bell. In terms of the rally, let's get over to Katie Greifeld right now. She can tell us what the indexes are doing the first few seconds of trading.
Pretty exciting as well if you take a look at the screen behind me. Like you said, Matt, currently the S&P 500 up 0.6% just seconds into the trading day. Even more so if you take a look at big tech, up 1%. Even small caps getting in on the action. The Russell 2000 up 0.7%. Of course, we got better than expected, meaning softer than expected, producer price index numbers this morning at 8:30, really raising hopes that we'll get good news when it comes to the consumer price index coming tomorrow. But before we get there, let's take a look at Starbucks, absolutely surging on news of a shakeup right now with Chipotle CEO taking over. The move, of course, comes as activist investors push for change at the coffee chain. That's what they got. Starbucks shares up 17.5%. On the other side, Shonali, you have Chipotle down over 8% right now.
What an absolutely massive week for the consumer sector. Katie, we're also going to keep an eye here on Home Depot. It cut its sales guidance on expectations that consumers will continue to hold back spending in the coming months, citing both high interest rates and inflation. Home Depot at the open now down about 1.5%, Matt.
All right, I'm taking a look at the big picture here. On the S&P 500 over the past 3 months, we saw, in terms of closing prices, a drop from peak to trough of 8.5%. Now, we had Mike Wilson of Morgan Stanley on the program July 8th. He said we'd see a 10% correction, and if you look at the intraday drop from, I think it was 5669 down to 5117 or so, you see actually a 9.7% drop. So he was near as damn it to correct. We're pleased to say he's back here. Mike Wilson, Morgan Stanley, Chief U.S. Equity Strategist and Chief Investment Officer. There you have it. Basically, the 10% correction that you called, we're wondering, is that it?
Well, you never know, right? I mean, but we thought it would happen in the third quarter, so it just happened immediately. And there's always different reasons for why it happens. Look, our general take on the correction that we've seen is that we're probably going to be stuck in this range now. I mean, we had a pretty big shock. It wasn't just the correction we saw in the equity markets, but then we had the carry trade kind of unwind. And I don't know how people can sit back and feel comfortable with that. The main thing, though, is what you guys have been talking about this morning, right? The consumer is slowing, right? All the consumer services companies in particular, it's not just the goods companies, and that has to be resolved here. So the way we think about it is, in order for markets to kind of make a new high, I mean, you need multiples to expand, and that's going to be very challenging in a world where growth is slowing, okay? Earnings expectations probably are still too high for the second half of this year, and a Fed that's reluctant to be proactive, okay? And I don't disagree. People are criticizing the Fed. I'm like, well, look, they're just being data dependent. I mean, and so they're doing their job. They're going to react if they need to. If they overreact, then that probably exacerbates the carry trade problem. So they're not going to overreact.
Whether you think you're going to get that 25 or 50 basis point cut over in September, it's still more than a month away. Right. So as rates remain elevated, how much more pain does the consumer see? Do you think investors are perhaps underappreciating how much more pain there's left in the consumer?
Plus there are lags, right? It's not like the Fed cuts at September 18th and the consumer goes to Home Depot and buys a new washing machine on September 19th, right?
Yeah. Well, that's generally been our view, right? I mean, we've been underweight consumer discretionary and sort of overweight the later cycle groups and then defensives on that premise, meaning, we think being defensive right here makes a lot of sense for all the reasons you mentioned. All these things work with a big lag, and I completely agree. In fact, our note this week, we discussed this in detail, particularly housing. Right, 25, 50 basis points isn't going to do anything, mainly because most people's mortgage rates are sub 4, if not sub 3%. So you need 200 to 300 basis points of cuts to really get some of these interest rate sensitive areas moving, and that's just going to continue to weigh on consumer sentiment. It's going to weigh on consumer stocks, and so that's how we're set up. We're set up to be sort of underweight that space.
And Mike, I want to get your thoughts on some of the technicals here, specifically when it comes to positioning in the big tech sector, because there's a note out from Citi Citigroup this morning saying that there's still $22.5 billion worth of long positioning on the NASDAQ 100. And in their view, that makes the index still pretty vulnerable here to any sort of sentiment shock, maybe at 8:30 a.m. tomorrow morning. What are your thoughts on positioning right now after the few weeks that we've seen?
Yeah, I mean, the faster money crowd has adjusted significantly, even the systematic strategies and some of the long-short community. But the asset owners, right, retail, long-onlys, that crowd is still very exposed. And so there is length in the marketplace. It's not just NASDAQ 100. It's kind of equities writ large. So the way we think about it right now is the valuation is just inappropriate, right? Valuation doesn't matter until it matters, and then that's all that matters. And we've been very adamant that 19 times is kind of a fair market multiple in a soft landing. Okay, so today we're north of 20 times still. So it's very hard for me to get excited about the index, which is why we're really focused at the stock level and the sector level to try and make money.
A little more on the carry trade here, because the carry trade is not really isolated to the yen. I think that's an important dynamic of this. The other important dynamic, I think, is how much investors didn't realize how much leverage was under the system. If you think about kind of what is left to unwind, these kind of exogenous shocks, do you still worry that there could be another one this year?
Well, there's still a lot of leverage in the system. I mean, so that I just sort of spoke about equity length is high, okay? Bond length is low. So, I mean, people are skewed to having more risk on. Then you take into account the leverage in the system through products like triple levered ETFs or, daily expiration options, just the leverage in the system as people are doing carry trades of all sorts. Yeah, there's more leverage in the system than there should be, given the uncertainty still of the eventual outcome of the economic, events that are still in front of us.
Speaking of those, you said you expect earnings to be weaker in the second half. We've had an excellent earnings season in the second quarter. Right. I think 11% is what we've seen in terms of profit growth year over year. Why is the second half going to be harder? Do you think tough comps from last year? Do you think we're not going to see a continued broadening out of earnings growth?
So, one part of it's expectation. So there's a big hockey stick in the fourth quarter, and there's been a lot of discussion around a pickup in orders in the second half of the year that continues to be elusive. So as we come into September, and we wrote about this week too, the key data for us is going to be what are companies saying in September about order books. If we don't see order books pick up in September, your year is kind of shot in terms of seeing a reacceleration that's now in the numbers. So we're open-minded. It could change. But I don't think it's going to be because the Fed's cutting rates. It's going to be perhaps maybe people hunkered down a bit, and now we can see a reacceleration. But the comparisons are difficult, as you mentioned, particularly in the fourth quarter for the Mag 7, and that's part of the story too. And so look, the key thing that we look at is forward next 12-month earnings growth. That is now peaking. And when that peaks, that means multiples come down. And that's as simple as I can make it. So 20 times to 19 times, that's our baseline. That would be kind of at the lower end of that range we wrote about this weekend. And that would be a place where I would get interested at the index. That's still 4, 5, 6% away. And then if it gets worse than that and it gets cheap, then we'd get really interested. But that's like 17, 18 times.
And so tying this into some of the economic data that we've gotten in the past 24 hours, of course, we had the NFIB Optimism Index come out. That was good news. An interesting detail within it, though, if you take a look at the report, it showed that the share of firms planning price increases dropped to a net 24%. That's probably good news for the inflation picture, but I read that as basically these firms are out of pricing power.
Yeah. It's a really good point. And I think this is be careful what you wish for on inflation. We've been talking about this for a while. The market did sort of make its top. Okay, part of that was on a good lower CPI number, and we wrote about that in early July. Weaker inflation data now is potentially bad news for stocks. Good news for bonds, okay? Bad news for stocks. Why? Because that's pricing power, to your point. And the PPI in particular is more aligned to revenue growth than even the CPI. So I'll be interested tomorrow to see if we get the same data point. I'm not excited for stocks because inflation is surprising on the downside. I'm excited that maybe my trade in bonds looks better, and that's why we like defensive stocks. And I think that all kind of syncs nicely.
Well, Mike Wilson, sit tight. We're going to take a quick commercial break. Mike Wilson of Morgan Stanley sticking with us. Let's take a quick check on this market right now. Of course, 9 minutes after the bells rang. You can see this rally building on the momentum that we saw in the pre-market. The S&P 500 up about 0.8%. The NASDAQ 100, big tech, extending the rally up 1.2%. Small caps, too, getting in on the action, of course, after that softer than expected PPI reading. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's get a quick check on what's going on in stocks right now. We have, in terms of the indexes, rallies. You can see the S&P 500 up 0.8% at 5387. The NASDAQ 100 gaining more than 1%. And even the small caps, the Russell 2000 up 0.8%. So across the board gains on, I guess, optimism that the Fed has more room to cut now that PPI producer prices didn't rise quite as quickly as we had been anticipating. Katie?
Yeah, and we'll see, of course, if CPI can keep the party going tomorrow. But for now, it's time for top calls. Some of the analyst action in focus this morning. And first up, Citi says Hormel is a buy. The analyst sees upside earnings potential for the deli meat maker thanks to improving sales trends and lower feed costs. Next up, Bernstein says that Warner Brothers Discovery no longer a buy, cutting its recommendation to market perform. The media company, of course, is still reeling from last week's quarterly earnings report, in which it reported a $9 billion write-down stemming from the losses at its TV networks. And finally, Wedbush initiating coverage of Artiva Biotherapeutics with a buy. The biotech company focuses on autoimmune diseases and cancers. Also initiated at a buy over at TD Cowen, Needham, and Jefferies. Shanali.
And Katie, we're back here with Mike Wilson, Chief U.S. Equity Strategist and Chief Investment Officer at Morgan Stanley. And Morgan Stanley adding 3 stocks to their fresh money buy list. Can you explain kind of what the thinking was behind adding these 3? It was AbbVie, Northrop Grumman, and Public Service Enterprise Group. You guys are hunting for value, it feels like.
Well, we're hunting for defensiveness, right? So obviously one's a defense company, one's a utility, and one's a pharmaceutical company, and they're all in a pretty good uptrend right now. The technicals look pretty good, and we think this is what you should be gravitating towards. We've had some of a defensive posture really since May when we felt growth was peaking. That has worked. We're just sort of doubling down on that same view. And as you know, we tend to go sort of against the grain. We don't necessarily go with the momentum. This would be definitely an out of consensus sort of view at the moment. It's starting. We think there's more to go in the defensive rotation.
Do we not? If we see Fed cuts, I always think about how long it's going to take for them to work their way into the economy. But the market is instantly going to start to buy maybe mid caps, small caps, maybe the Russell 2000.
No. I mean, we've been very consistent. I mean, it could, yes, of course, but our view is that's not what you should be doing. We saw, once again, people tried to do that trade in July. It didn't work out so well. Now, we think that was more about a degrossing, okay? So as people rotated out of the winners, they were probably covering some of their shorts in these areas that they were underweight, and that really is what drove that. And now we have a very kind of negative technical pattern where it looks like that was a one-hit wonder. And historically, when the Fed cuts interest rates, small cap, mid caps do not outperform. Now, the market can go up, but typically small mid caps still underperform, even if it's a mid-cycle slowdown. That's what the data shows. I just think people either don't understand that history, they're just eager to do something different. That's not the trade. We think the trade is to stay up the quality curve and skew more defensive than growth-oriented, because rates coming down will be most beneficial for that cohort.
And the point has been made that you take a look at some of the small cap indexes, such as the Russell 2000, it's a bit junkier than it has been in the past. I have to imagine some of that is that you aren't seeing those smaller companies IPO, those high-quality small companies actually tap the public markets.
It's a very good point. I mean, the thing that's really been missing is we haven't seen a lot of equity issuance, and we know there's supply out there. There are companies that probably, want to go public. There's probably companies that want to raise equity capital because their balance sheets are a little sloppy, and it just hasn't happened. And I think the reason why is there's not a strong bid for that. I mean, we've seen that all year. Once again, the Russell 2000 is basically flat on the year. The equal weighted Russell's down on the year. The equal weighted S&P is still underperforming the overall S&P. So the breadth of the market continues to be soft, and that just continues to speak to this idea that we're late cycle. It's not mid-cycle. Fed cutting usually makes the market narrower, not broader.
Well, just to follow up quickly on that point, like you said, there hasn't been that consistent bid. Does the logic then follow, if we did see a consistent bid for some of those smaller companies, that IPOs actually would pick up here?
It could, absolutely. I mean, we're open-minded, as always, to anything. If we were to see in September, for example, a very broad rally like in July that looked a little healthier, meaning in an up market, not a down market, not a degrossing, then we would have to revisit our view on that. Something else would be going on that would suggest that, hey, maybe the Fed is not only going to cut rates, but it's going to have a meaningful impact, and it's going to help these companies. The other thing you brought up a good point is the Russell 2000 is really a lower quality version of small caps. So I want to make it clear, like, we don't hate all small cap companies. I mean, that's silly. the S&P 600 is a higher quality version of that. And so as you hunt for small mid-cap stocks, and I would advise doing that, just once again, stay up the quality curve. You don't have to go down to the junk pile.
I really feel the need to go back to something we were talking about before. You sat down, we said, okay, Mike Wilson can take his victory lap. We saw that 10% correction, nearly 10% that you were thinking of. You saw it earlier than we expected. What does this mean? Does this correction have further to go?
Well, it's still the third quarter, okay? And once again, the seasonals right now are just not particularly great. So as I said at the beginning, I think we're going to stay in this range. I find it hard to believe we're going to break out back towards the highs. I also don't think we're going to completely break down in a way that would argue that we're entering a new, bear market, okay? But the lower end of the range is, to me, the magnet now, because that's where the valuation support really lies. 19 times is closer to the low end of that range.
You said you're focused on jobless claims. I talked to Ed Hyman on Sunday from ISI. He said the same thing. If we get a labor market that really weakens, and the SOM rule's already been triggered, but if we get, for example, I think September 6th, we get non-farm payrolls, and if we get another jump up in unemployment to 4.6%, do you think we see more mayhem in the markets?
Yes. I mean, a 4.6 would be pretty definitive. Now, just to be clear, our economics house call is still we're in a soft landing outcome. What I would suggest, though, is that the market is priced for that, right? The market is priced for a soft, actually even better than a soft landing outcome. It's priced for a reacceleration. So just kind of putting a little risk back into the market that maybe the hard landing is no longer zero, but it's 20 or 30% again, that once again just argues that multiples will probably bleed lower into September, even if the jobs data is kind of stable. Because at the end of the day, the jobs market is weakening. And so how could you sit here and say that the risk of a recession is zero, which is kind of what's priced in the equity market? And one last thing, the bond market is definitely pricing a higher risk of a hard landing. I mean, that's what the yield curve is telling you. That's what the 2-year yield versus the Fed funds is telling you.
Does that divergence worry you as an equity?
Well, I'm just saying as an equity person, you should pay attention. I mean, the bond market has probably a better look at, okay, what is the risk here? The bond market is not saying recession, to be clear. It's saying the risk of a recession has gone up in the last 2 months, which makes sense given what you just said.
All right, Mike Wilson, we have to leave it there. Great point to leave on, though, that you can't look at any asset class in a vacuum. Mike Wilson, come back soon. That, of course, is Mike Wilson of Morgan Stanley. Now, we need to go back to what's going on with Starbucks because it is a monumental move that we're looking at. Starbucks up 21%, Shonali, biggest move ever.
Chipotle also is steepening its losses, down more than 12%. Elliott is out now with a statement. Of course, this is the big activist hedge fund firm that took a stake in Starbucks. They say that they have been engaged with the board for the past 2 months regarding their perspective, and they view today's announcement as a transformational step forward for the company. They welcome Brian Niccol. They look forward to continuing their engagement with the board, so it's not over yet, and they work toward the realization of the full potential, according to a statement.
I think everybody has to be careful. I mean, this is like key man risk, right?
Yeah.
Just because one guy moves from a chain that makes delicious burritos that you can't get at the office to a chain that makes expensive coffees that are free upstairs.
Starbucks shares up on a day by $18 billion in market cap. He's an $18 billion man, Katie.
There you go. Of course, we'll see if that momentum actually continues, of course. But speaking of activism, up next, we're going to tell you about an activist fund that's had an impressive run-up so far this year. That's next in our Wall Street Beat. This is Bloomberg.
It's time now for the Wall Street Beat, and today we're looking at the success of an activist fund run by Boaz Weinstein. The Saba Capital CEF Special Opportunities Fund jumped over 20% this year so far. It invests exclusively in a handful of closed-end fund products from BlackRock. Bloomberg hedge fund correspondent Kathy Burton now here with us to talk about exactly how he has made so much money, because the reality is when he's attacked a lot of these funds, he didn't really win those board seats.
No, he didn't, but the BlackRock has agreed to buy back shares in a lot of the funds, and that's helped the price rise. So he has had a victory in there.
But you also think about the closed-end fund universe. Of course, a lot of these closed-end funds have been trading at pretty big discounts, historically significant discounts to their net asset value. It feels like also just the market is in his favor right now, because we have started to see those discounts narrow at large.
Yes, that's true. And so it's hard to say that it's what part is luck and what part is him pushing the companies to do something. But it has worked this year for him.
So, I mean, I can only think about Bill Ackman when I think of giant closed-end funds, although his, in this case with PSUS, didn't come to fruition. Do we know any more about that? Are they just rethinking it and going to launch a different kind of product?
That's what we've been told, but we have no details about what that is. There's been a lot of chatter about what it could be, but we're really just waiting to see at this time.
One more on Boaz here, because realistically, when things get hard is when he used to make a lot of money. Volatility, which we saw last week. So has he changed his identity here? Is he more of a closed-end fund activist now than he is a tail fund manager?
Well, it really depends on the market, I think. When things when there's not a lot of volatility, then he's made a lot of money historically on these closed-end fund products and bets. And when there's a lot of volatility, like there was in 2020, for example, he made a ton of money in his more traditional way. So I think last week he did well, but I think before that there hasn't been that much volatility this year.
All right, Catherine, thanks very much. Catherine Burton there reporting on, in this case, Boaz, but I recommend you go to the Bloomberg and check her byline for deep reporting in the Wall Street Beat. Let's get to the trading diary. This is what you need to be watching this week. We got PPI today. Tomorrow we get CPI, so more inflation. On Thursday we get retail sales, which Shanali's watching very closely, plus earnings from retail giant Walmart, as well as farm equipment maker Deere. On Friday, U.S. housing starts to release, plus UMich consumer sentiment data. This is Bloomberg. All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Bassett.
And I'm Katie Greifeld.
Coming up, U.S. producer prices rose in July by less than forecast. And it underscores an ongoing moderation in inflationary pressures.
And an abrupt shakeup at Starbucks. The coffee chain surges after naming Chipotle CEO Brian Niccol as the new CEO and chairman.
And in today's C-Suite, we'll take a closer look at the health of the consumer with the CEO of Tandra Shopping Centers and Shark Tank's Barbara Corcoran. But first, before we get there, let's take a look at this market. Of course, 30 minutes after the bells rang, you can see that rally is well underway. The S&P 500 currently up about 0.9%. A big rally on our hands when it comes to the big tech companies. The Nasdaq 100 up about 1.4% after that softer than expected PPI read this morning. And you can see that in the bond market as well. 10-year Treasury yields currently down about 4 basis points, Shanali.
And in the last hour, we sat down with Morgan Stanley's Mike Wilson. And here's what he had to say about the U.S. consumer.
Consumer is slowing, right? All the consumer services companies in particular, it's not just the goods companies, and that has to be resolved here. So the way we think about it is, in order for markets to kind of make a new high, I mean, you need multiples to expand, and that's going to be very challenging in a world where growth is slowing. Okay, earnings expectations probably are still too high for the second half of this year, and a Fed that's reluctant to be proactive.
Joining us now, Kestra Chief Investment Officer Kara Murphy. She helps oversee $122 billion in assets under management. And you think about the worries about the consumer under the surface and what we're seeing this week. Yes, there are some one-off stories with Starbucks and Chipotle, but you saw what happened at Home Depot, and you realize that perhaps there might still be more pain to come. How do you feel about it?
So we've been seeing for a while this kind of more cautious consumer coming. So if you even go back a couple of years and look at these huge COVID era payments, those started to subside. We started to see savings subside within consumers, and we've started to see more caution. So if you look at consumer confidence numbers, those have been at lows, which is quite surprising given the broader economy. Now, what's buoyed the consumer has been a very strong labor market. And of course, in the last few weeks, we've seen a little bit softer data on the labor side as well. So I think this has been a long time coming, and it's not necessarily unhealthy. The U.S. economy has been really strong and has been held aloft by a lot of this consumer spending. And so now we're seeing a little bit more caution enter the market, which kind of makes sense.
Doesn't it seem like that's going to continue? I mean, we've seen consumer weakness from trip bookings. TripAdvisor, Airbnb showed some consumer weakness. Disney parks showed not the kind of consumer spending growth that we were expecting. And it strikes me that it's going to be difficult to turn Starbucks around in the face of this, right? No matter who the star CEO is that you bring in.
Yeah, I would expect this to continue to soften, right? The Fed needs to see the labor market soften more from here. If that happens, that will additionally slow consumer spending. What we've also seen, if you look in, for instance, credit card data, that has really helped some consumers kind of keep their spending aloft. We're starting to see higher delinquencies. So it's very much this kind of careful balancing act between allowing the consumer to slow a bit, but then also with interest rate cuts on the horizon, that can help ease some of those burdens on the credit side. Now, I think with Starbucks, it's super interesting. It's not often that we get to see in such stark reality the importance of management. And so, you look at Starbucks versus Chipotle, same sort of macro consumer trends that are affecting both of those companies, but very different experiences today. Now, your question is, can the new management come in and sort of move beyond those macro forces? The market is telling us that they think the new management can in fact do this.
Well, I want to talk a little bit more directly about that, because you take a look at Starbucks, it's up 22%, almost 23%. That, of course, is the biggest rally, one-day rally ever for that stock. And I see your point that management is important here, but does this start to feel a little bit over-egged? I mean, are we introducing key man risk into this stock?
I think it is a little dangerous when you put too many hopes on a single management team. One other thing that I want to highlight, though, is part of this management reshuffle at Starbucks is also re-emphasizing non-U.S. And so that's a really important part of this whole consumer story, where it's not just reliant on the U.S. consumer, but the broader international consumer as well. So for sure, they have, a tough job ahead of them.
Have you restructured your portfolio to account for this kind of consumer weakness? Do you think the broader market has done it already?
I think we're likely in for some more volatility in the near term. Now, it's not just, U.S. consumer that's a concern. We also have political risk here in the U.S. We have geopolitical risk outside. You have valuations at highs. So it makes sense that the market has a little bit of grinding to do over the next few weeks or months. But that said, we've been sort of keeping our positions where they are. And that is we're expecting second half of the year for the market to continue to broaden out a little bit outside of these Mag 7 names and start to see some other areas of the market do better.
So how are you playing that broadening, Kara? Do you buy something like the S&P 600? That was kind of a recommendation we saw over from Mike Wilson and Morgan Stanley. Perhaps the Russell 2000 is too fragile, but there are other ways to get at those small and mid caps. Or do you buy specific names?
I think the S&P 6 is a great example of where you're going a little bit down in market cap, but not all the way to the super small names that might be a little bit more at risk in a softening economic environment. But even just outside of some of the largest names within the S&P 500, you still have opportunities on the lower end of that 500 scale. So as soon as you kind of get outside of that very small area of the market that's done very well, you start to see a lot more opportunities, a lot more valuation support, more earnings likely to come in the second half of the year. So there's a lot to pick from.
Well, that's what I want to talk about because we launched this show on July 8th. Suddenly, small caps were ripping. Some of those unloved sectors were absolutely ripping. And a lot of people told us that you're going to see earnings broaden out and support that momentum in the market. It feels like so far, you take a look at the earnings picture, it's been kind of mediocre. We haven't necessarily seen that broadening out. So what makes you confident that we will see it in the second half?
Yeah, it's been interesting because there was a moment where small caps outperformed and then it did a quick round trip. But we were talking even then as we were sort of optimistic about continued small cap outperformance that it was not going to be a straight line. It never is. But when you look at forward expectations for earnings within the smaller cap side, those are expected to start to really ramp up in the second half of the year and into next year. And what happens is that when you have this massive valuation differential between small names and large names, the market is a little bit better able to wait for those earnings to really come. So again, this won't happen tomorrow, but we think over the next 2, 4, 6 quarters that we'll start to see some more earnings support for those names.
Kara, great to have you on the program. Thanks so much for joining us. Kara Murphy is Chief Investment Officer of Kestra Investment Management. More now on that Starbucks news. Last hour, we spoke with Nancy Tangler of Laffer Tangler Investments. She owns both Starbucks and Chipotle.
Nickel just worked magic at Chipotle. It's a member of our 12 Best Ideas portfolio, so now we're going to have to think a little bit about what we do there. But he did all the right things and really drove the company through the use of Chipotle lanes, through the use of digitization, where they now get over $1 million per store in digital orders. So he will fix Starbucks. I think that's the very good news, and we'll have to see what happens at Chipotle.
Joining us now is Andrea Felstead, Bloomberg opinion columnist covering consumer goods and the retail industry. And Andrea, it's amazing to watch, these share price moves, the biggest gain Starbucks has ever seen, instantly adding 20% to their market cap. But can one man, as good as he was at Chipotle, really bring back Starbucks, which has been, simmering on low?
Well, the thing about Starbucks, it's not a big breakup or a big shake-up. It's about doing lots of little things better. And it sounds like from what he did at Chipotle, that's exactly what he's doing. So in theory, he should be able to do that at Starbucks.
So you think about these moves that you're seeing here, and what is the biggest challenge? On one hand, there's a worry about the crunch on the consumer, but you did see Chipotle still navigate that.
That's right. I think the biggest challenge is you're coming into a company, you've got an activist investor, Elliott, they have welcomed his appointment. You've also got Howard Schultz, still a big shareholder, chairman emeritus, still, cares deeply about the company. He's got to manage those factors. So he's got to push through all the changes that the company needs while managing those rather tricky factors.
Yeah, of course, a lot of cross currents there. So, you add it all together. Do you think that Brian Niccol, the thinking here is that the board wants him to come in and make a big change? Is that what they're looking for by looking outside?
Yes and no. I think they clearly want the operations to improve. There's going to be a big test on what they do, say, with China. Do they sell all or part of China? Howard Schultz has been a big, fan of the China business. Other investors want it spun off. So that, I think that'll be a key test of just how much freedom and how much leeway the company gives the new CEO to really make those far-reaching changes.
One thing here that Elliott's statement said today was not only do they welcome this as a transformational step, but also that they look forward to working with the company and continuing our engagement. When you still have an activist in your stock like this, what does it mean about maybe the way that Brian Niccol would run the company if he wasn't just doing it without Elliott on his back?
It can actually be rather helpful. So if you're a new CEO coming in and you've got an activist, actually having the activist there can give you a bit more license for change. We saw this with Nestle. Nestle had a new CEO, they had an activist, and actually that allowed the CEO to push through some things that, were quite new to the company. He actually did big disposals and acquisitions. Starbucks doesn't need that, but it does need change, and having that activist investor can be helpful.
And Andrea, I'm curious to get your thoughts on where this leaves Chipotle. Of course, we've been talking about this whole show, how since he took over in March 2020, we've seen Chipotle shares absolutely fly higher, up about 280% before the start of trading today. I mean, it feels like they're losing a pretty big asset here.
Exactly. They will have to, really just carry on. It does seem as if they are back on track. So they, the new management will have to sort of carry on. But sometimes when you take over from a very successful CEO, that can bring its own pressures. New management must continue their sort of legacy and then sometimes move in a different direction. It can also be quite tricky. We've seen, new CEOs after long tenured predecessors sometimes not have the easiest time.
We should point out Chipotle shares, the drawdown from the peak in June is 30%. So they've lost almost a third of their value since they hit that high. Andrea, here in the U.S., we have been contending with consumer weakness throughout really a strong earnings season. You cover this industry globally. Is it specific to the U.S. or do you see it in the U.K. and Europe as well?
I think the UK is slightly different. The UK is actually sort of, I think, on the road to recovery. Inflation's coming down, interest rates are coming down, wage growth is still healthy. The consumer should be in a good place. What we're seeing is a real disconnect between what should be a feel-good factor and what people are spending.
Andrea, we thank you so very much. That is Andrea Felsted of Bloomberg Opinion. Now, just taking a quick look here, it's fascinating. When you see this drop in Chipotle's stock as well, you do have Bill Ackman in Pershing Square being one of the biggest losers here. Remember, at the end of last year, Chipotle was one of the top 3 holdings in his fund. You see it in the performance of his closed-end fund. Chipotle today losing almost $10 billion in market cap.
So certainly a painful day. But, I mean, it's important to note that he's
a painful couple of months because it's down 30% since June.
When it comes to Chipotle, I mean, he's held this stock for years. We've been talking about the good performance over the past 4.5 years or so. It's interesting, too, if you bring in Starbucks, he cut his Starbucks stake in February of 2020. So, of course, he's been involved in both of these names that we're talking about.
Fascinating. So he made some of the pain from Starbucks, but certainly now missing out on those losses over at Chipotle. We're going to switch gears next. We're going to talk about the world's richest man angling for a new gig. We're going to, of course, talk about Elon Musk and that big conversation he had with the former president last night. Details of that up next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, the medical device maker Baxter International announcing today it will sell its kidney care unit to Carlyle for $3.8 billion. Now, the transaction expected to close later this year or early next year. Carlyle, of course, has been a private equity investor in the medical tech sector for over 10 years. Next up, General Motors has been laying off staff in China as it overhauls its operations in the region. Now, these cuts represent a major strategy shift for the company, which earned billions of dollars in China as recently as 2018. GM, of course, though, is facing overcapacity in the region thanks to a flood of local competitors. And the Roger Federer-backed On Holdings reporting a mixed bag of earnings. The sneaker maker saw sales jump 28%, but the gross profit margin came in behind estimates. On, of course, trying to find a foothold in its challenge against established players such as Adidas and Nike. And finally, Home Depot raising a warning flag on the U.S. economy. The DIY retailer says that consumers are spending less to remodel their homes thanks to high interest rates and concerns that the broader economy is souring. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
Elon Musk interviewed former President Donald Trump last night, and this Tesla CEO took the opportunity to pitch himself for a second role in the Trump administration. Take a listen.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, the taxpayers' hard-earned money, is spent in a good way. And I'd be happy to help out on such a commission.
I'd love it
if it were formed.
Well, you're the greatest cutter.
He's a great cutter, Elon Musk. Trump said earlier he was so proud of him for firing all those people at Twitter. For more on that conversation, let's bring in Bloomberg Businessweek columnist and co-host of the Elon Inc. podcast, Max Chafkin. Max, I was pretty astounded, actually, at the amount of pandering that Elon Musk did for this former president. And to be fair, you know, when you're talking to a former president, I'm sure you're going to be respectful, but it really seemed like he was trying to get something.
Yes. Yeah, it was crazy to me as well, listening to it, especially as someone who's followed Elon Musk for a long time. He tends to disagree with people when they say things, when they minimize climate change or say some of the things that Trump said. And he was, very eager during this conversation, as he said, to cater to Donald Trump. Of course, Elon Musk is a savvy operator, and I think he's doing his best to flatter a potential leader of the free world. And